You walk into a coffee shop and overhear three conversations. Table 1. I just bought more Tesla stock because Elon tweeted about robots. Table 2. I only invest in dividend stocks my grandfather would approve of. Table 3. I'm waiting for the market to crash before I buy anything. These are three completely different types of investors, and they'll all get wildly different results. Here's the thing nobody tells you. Your investing personality matters more than your strategy. Let me show you every type of investor and which one you actually are. The emotional investor. Meet Amy. Amy checks her portfolio 15 times a day. When her stocks go up, she feels like a genius. When they go down, she can't sleep. Sarah makes every decision based on how she feels about the market. In March 2020, Amy watched her portfolio drop 30% in 2 weeks. She panicked and sold everything. I need to protect what's left, she thought. Amy locked in massive losses at the bottom of the market. 6 months later, the market hit new highs. Amy watched from the sidelines as her old portfolio would have recovered completely. She finally bought back in at the top, just in time for the next correction. Amy has been investing for 10 years. The market returned 12% annually during this time. Linda's portfolio returned 3% because she bought high when she was excited and sold low when she was scared. The emotional investor's biggest enemy isn't the market, it's the mirror. They let fear and greed drive every decision. They turn investing into gambling by trying to time their emotions instead of time in the market. The value investor. Meet Warren. Not Buffett, just a regular guy named Warren who worships Warren Buffett. Warren only buys stocks that are cheap, based on price-to-earnings ratios and book value. He looks for companies trading below their intrinsic value. Warren spent 6 months analyzing a boring insurance company. The stock was trading at 12 times earnings, while the market average was 25 times earnings. Warren bought 1,000 shares and waited. 3 years later, the market discovered this hidden gem. The stock doubled as other investors realized the company was undervalued. Warren made a 100% return, while the market made 30%. But Warren has a problem. He's been waiting 2 years to find another undervalued stock. Everything looks expensive to him. Warren is sitting on cash earning 0%, while inflation eats away at his purchasing power. Value investing works, but it requires patience and the ability to look stupid for long periods. Warren might be right about current prices being too high, but he might wait 5 years for the crash that never comes. The growth investor. Meet Jessica. Jessica doesn't care about current profits. She invests in companies she believes will dominate the future. Tesla, Amazon, Netflix. Jessica buys growth stories, not current earnings. Jessica bought Amazon in 2010 when it was expensive at $50 per share. Value investors called her crazy. Amazon doesn't make any profit, they said. Jessica didn't care. She saw the future of retail. 10 years later, Amazon hit $3,000 per share. Jessica's expensive stock returned 60 times her investment. She made more money on one growth stock than most people make in their entire careers. But Jessica also bought Peloton at $150 because she believed in the home fitness revolution. The stock crashed to $8 when people went back to gyms. Jessica learned that growth investing means big wins and big losses. Growth investors make fortunes when they're right and lose fortunes when they're wrong. They're betting on the future, which is always uncertain. The key is being right more often than you're wrong. The index investor. Meet Bob. Bob thinks he's smarter than 90% of professional fund managers, so he doesn't try to beat the market. He just buys the entire market through index funds and waits. Bob puts $1,000 into an S&P 500 index fund every month. He doesn't research individual stocks. He doesn't time the market. He doesn't care about daily price movements. Bob is boring, and boring works. Over 20 years, Bob's portfolio grew to over $800,000. He never picked a winning stock, but he never picked a losing one either. Bob got the market's average return, which beat 80% of professional investors. Index investing is the ultimate set-it-and-forget-it strategy. You'll never beat the market, but you'll never get crushed by it either. It's perfect for people who want market returns without market stress. The day trader. Meet Alex. Alex thinks investing is for old people. He's a trader. Alex buys and sells stocks multiple times per day, trying to profit from short-term price movements. He has 6 monitors and drinks energy drinks for breakfast. Alex made $50,000 in his first year of trading. He quit his job and became a full-time trader. Alex felt like he'd cracked the code. Why would anyone buy and hold when you can make money every day? Then Alex had a bad month. He lost $30,000 in 3 weeks. Alex doubled down, trying to make it back quickly. He started using margin to amplify his trades. One bad trade wiped out his entire account. Alex learned that day trading isn't investing. It's gambling with better marketing. Studies show that 80% of day traders lose money. The few who make money usually make less than minimum wage when you factor in the time invested. Day trading appeals to people who want to feel smart and make money fast. But the market doesn't care about your feelings, and fast money usually becomes no money. The dividend investor. Meet Margaret. Margaret is 65 and retired. She doesn't want growth, she wants income. Margaret only buys stocks that pay dividends. Her portfolio generates enough cash flow to cover her living expenses. Margaret owns boring companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies have paid dividends for decades. Margaret collects 4% per year in dividends and sleeps well at night. But Margaret missed the technology boom. While her dividend stocks grew slowly, tech stocks like Apple and Google created massive wealth. Margaret chose safety over growth and paid an opportunity cost. Margaret's strategy works for retirees who need current income. But younger investors might be better off buying growth stocks and selling shares when they need cash. Dividend investing is perfect for people who want to live off their investments. Just remember that high dividends often signal low growth prospects. The momentum investor. Meet Tyler. Tyler buys stocks that are going up and sells stocks that are going down. Tyler believes that trends continue longer than people expect. If a stock is rising, there's probably a good reason. Tyler bought GameStop at $40 because it was trending on social media. The stock hit $400 in 2 weeks. Tyler made 10 times his money by riding the momentum wave. But Tyler also rode GameStop back down to $20 because he thought the momentum would continue forever. Tyler learned that momentum works until it doesn't, and when it stops fast. Momentum investing can generate huge returns in trending markets, but it requires perfect timing to get out before the trend reverses. Most momentum investors give back their gains by staying too long. The contrarian investor. Meet David. David does the opposite of everyone else. When people are panicking and selling, David is buying. When people are euphoric and buying, David is selling. David believes the crowd is usually wrong. David bought bank stocks in 2009 when everyone thought the financial system would collapse. He bought oil stocks in 2020 when prices went negative. David made fortunes buying what others were selling. But David also bought Blockbuster stock in 2005 because everyone said Netflix would kill video stores. Sometimes the crowd is right, and contrarian investors get crushed by being too early or too stubborn. Contrarian investing requires strong conviction and the ability to be wrong for long periods. You need to distinguish between temporary panic and permanent change. The passive investor. Meet Linda. Linda contributes to her 401k every paycheck and never looks at it. She has no idea what stocks she owns or how they're performing. Linda treats investing like a savings account that hopefully grows over time. Linda's 401k has grown to $400,000 over 20 years. She never made a single investment decision beyond choosing a target date fund. Linda proves that doing nothing can be the best investment strategy. But Linda also missed opportunities to optimize her portfolio. She paid high fees for actively managed funds when cheaper index funds were available. Linda's passive approach worked, but it wasn't optimal. Passive investing is perfect for people who don't want to think about money. Just make sure you're being passive with low-cost diversified funds, not expensive, actively managed ones. The which type are you? Here's the truth. Most successful investors combine elements from multiple types. Warren Buffett is famous for value investing, but he also bought growth stocks like Apple. The best investors adapt their strategy to market conditions. The key is knowing your personality and choosing a strategy you can stick with. The emotional investor needs to become more systematic. The day trader needs to become more patient. The passive investor needs to pay attention to fees. Your investment returns depend less on which stocks you pick and more on which behaviors you avoid. Don't let emotions drive decisions. Don't try to time the market. Don't chase performance. Don't panic during crashes. The most important investment decision isn't what to buy, it's what type of investor to become. Choose a strategy that matches your personality, timeline, and risk tolerance. Then stick with it through good times and bad. Because in the end, time in the market beats timing the market. And the best investment strategy is the one you can actually follow for decades without abandoning it during the first major downturn. The market doesn't care what type of investor you are, but your results will depend entirely on which type you choose to become.